Good afternoon. Good afternoon, esteemed colleagues. On behalf of the Direct Tax Committee of ICA, I would like to welcome you all to the EU technical event focused on impact of Section 9 of Income Tax Act 1961 for non-residents, a comprehensive analysis, which is part 2. So part 1, we have already seen Section 9, subsection part 1, 2, and 3. So firstly, I would like to express our gratitude to our esteemed chairman, Sir Chadda sir, Piyush S. Chadda sir, and our Vice Chairman, CA Kota S. Srinivas sir of Direct Taxes Committee for their continued support and for gracing us with their presence today. Thank you, sir, for joining us today. And I also would like to welcome Singh sir. Today, he is also there with us, chairing the entire session for us. And I would also welcome the speaker for all the viewers today who are present with us. CA Piyush Chadda sir has been in practice for the last 24 years. He is a chartered accountant, senior partner at Messrs. Chadda and Doshi. He specializes in direct and indirect tax appellate proceedings and arbitration proceedings. He is a speaker on various topics of direct tax, a member of Working Committee of Asian Federation of Accountants, shortly called AFA. He is a member of External Committee of Reserve Bank of India's Asset Reconstruction Committee, a vital contributor to WIRC publication on Vivad Se Vishwas scheme, and he's also a practicing litigation in direct as well as indirect tax. So I now would like to request him to deliver a few opening remarks.
Very good afternoon. Thank you very much, Sneha. This is CA Piyush Chadha, Chairman of Direct Tax Committee. I recognize the presence of my esteemed Vice Chairman, CA Kota S. Srinivas from Bengaluru, Speaker for the day, Chetnaji, Moderator, CA Sneha, other office team members from DTC, the Special Advisor to Direct Tax Committee, SP Singh Saab, whose expertise in international tax is great, being an ex-IRS officer involved in the policy making of the tax, is a great asset to our committee and has been always a support. And all the esteemed participants who are the esteemed members of this Institute of Chartered Accountants of India. A very good afternoon to all and warm welcome to you once again on this Thursday seminars, wherein we are discussing topics of direct tax and also international tax alternately. I do understand this is the second part of NRI taxation, especially concentrated on Section 9, and I'm sure Chetna will take it forward from where we stopped last fortnight. So it would be a great learning experience. Coming to being a chairman of Direct Tax Committee, I thought I generally always, and obviously if some of participants who have also heard me earlier, you may find it repetitive, but it is important to know what is happening in Direct Tax Committee. All you may be aware, there is one of the most important thing which is happening today. We have carried out a survey on the limits of tax audit to be carried out by a practicing chartered accountant. Now, this survey was open for the general public comments, from the membership or rather, and we got total 4,087 comments, which we are synchronizing, verifying, compiling, and to see that what does member feel, whether the number of tax audits which can be carried out by a single individual chartered accountant should be less than 60 or more than 60. So that revision is to be undertaken. The results of that particular survey would come into the public domain in some time, and then it would be presented to the council for taking a decision on that. I'll just give you a background of that. You may be aware the limits of the tax audit was now before the challenge, and the Supreme Court in its judgment, I think it came in the month of May, when it has held that the power of the institute to issue guidelines to put a reasonable restriction is valid within and it is within the limits. So the last limit was fixed in 2014, that is almost 10 years. Why don't council consider of revising it? So that was the background whereby we invited various comments and we started the survey Google form. It was open up to 9th June. And we have already received a lot of comments that would be considered. Once whatever is considered and approved by the council, if the changes are happening, it would be notified by the Institute of Chartered Accountants of India. Apart from that, the most important, which is undergoing, we have sent you an email in regard to an implementation guide on revision in Form 360. Most importantly, it covers amendments which have been made in the responsibility which has been casted on the auditors to report under Section 43, capital B, subclause H. Generally, this is an implementation guide, and we do not actually expose to the public. Neither we generally take our comments because it's a recommend. It would be a recommendatory in nature. Though I always insist to my members, whosoever is performing assurance function, that they should follow implementation guide, though it is called recommendatory, it would help them in ring fencing themselves. So if you are put to a question tomorrow that why a particular decision was taken in a particular manner, you can always say, you can always fall upon the implementation guide, which is issued by the institute, which is considered by various courts as a body of experts when it comes to auditing and accounting. This implementation guide, we have done a mass mailing in this regard. All the members, all the chartered accountant members, 4,10,000 have been sent mails for, and the period we had sent it yesterday itself. And all of you would have received by now. If you have any comments upon that, if you have any suggestions or recommendations to be made before it is finalized and approved by the Direct Tax Committee, which is happening on 20th of June, we will definitely, each and every such suggestions and recommendations will be considered, will be taken into it, will be discussed at Direct Tax Committee, which is happening on 20th. And if felt appropriate, the appropriate changes will be made before it is actually finalized and issued for the use of the members. So please do look into those mails. If that mail is not available, I will also tell now my technical team who is over here that we can host that draft copy also on our website, so it would be available. Or you can, generally, if you have any suggestion, you can write to dtc@ici.in. Apart from others, we generally keep on making a lot of representations to the CBDT. And when like pre-budget, which we had submitted on 24th of April, subsequent to that also a lot of suggestions keeps on going. If any members, if they are facing any problems in implementing a particular act, or if there is some problems with the adjustments which are made by the CPC, and if those are not a problem which is related to a particular assessee, but it is a problem which is goes to the root of the changes to be made in the particular formats or the forms or whatever, you please do write us to us. We will consider those individual representations and will also put forward that to the CBDT. We are quite hopeful and we are aware that CBDT is very seriously considering whatever representations have been made by Institute of Chartered Accountants of India. And I'm sure it will help not only you, but membership at the large. So even your one single suggestion, if it can make the changes and it can help the membership at large, I'm sure it would be done well. Coming to international taxation, yesterday we just had a meeting with the Cyprus embassy officials, wherein Cyprus, which is one of the top 10 countries from which investments are coming in India, they are considering having a tax reforms in their country, and they are seeking some information from it through an Indian embassy, that any suggestions which can be set. So SP Singh is leading that team, being a master in international taxation. They will be sharing with us all the documents, what is the tax reform paper which they have come out. And the Direct Tax Committee, after considering all these suggestions, we have also taken trying to take a suggestions from experts in the international tax, or who is actually knowing the Cyprus tax laws, or who is actually working on the DTA between the Cyprus and India. I know the DTA was made instrumental or was signed by the time when SP Singh was there, and he himself had visited that country at that time. And he's aware of that. But if individual members are aware and if they have any suggestions on that, also please do write to us. We'll definitely consider that. Of lately, the Lok Sabha has been constituted. Prime Minister has been sworn in. The first Lok Sabha has been announced on 24th. As per our information, there would be an economic survey coming in the first week of July. That is when Lok Sabha is functioning between 1st, 2nd, and 3rd, because the Lok Sabha's dates which have been given is 24th June to 3rd July. But I believe the budget will not happen in this first session. Budget, what information we have today is that it would come somewhere in 3rd week of July. It's a very important area for our practitioner chartered accountants, because when the budget comes, I know a lot of programs will be happening. A lot of members are interested what is happening, and based on that, they also do plan affairs, give their advices to their clients to look forward. So I thought I'll just update you on this. So thank you very much once again, Chaitanya ji, for joining us, Sneha for moderating this event, my Vice Chairman Kota ji, and SP Singh Saab. Over to you, Sneha. Thank you very much. Have a very great learning.
Thank you, sir. Thank you for your insights and your latest updates and amendments, both in direct tax and international taxation. That was very helpful. I'm sure all the members have taken note of everything and the things to look forward to in the upcoming sessions as well. So now we have with us CA Kota Srinivas sir. He is a BCom graduate from Bangalore University, fellow member of the Institute of Chartered Accountants and also a member of Institute of Cost and Works Accountants of India. He is a partner at SSB and Associates. He has served in the institute for over more than 2 decades. He has been instrumental in developing digital project for SIRC. He was also instrumental in collecting around 1.5 crores towards the ABF fund in the year 2017-18. And so as he says, he is fondly known as think differently and act perfectly. So I request CA Kota sir to give his remarks for this session today. Sir, you're muted.
Okay, thank you, Sneha. First of all, let me welcome all the members who have participated in this particular webinar. I welcome Chaitanya E from Tirupati, who has accepted our invitation to be a speaker on this particular topic. I also welcome the chairman of DTC committee, CA Piyush Chhajed sir. Then our, I should say, a guide for DTC committee, Sri SP Singh sir. All the other secretaries and other staff members of DTC and all of you. As you know, this is a second part of the Section 9, what we were discussing. Last week, we had Prasanna who discussed about Section 9. As you know, now it's a trend of having part 1, part 2 of movies like that. So we also thought, let us have a part 1, part 2 of various topics. I think last month we had part 1 and part 2 of charitable and religious trust as well. Now, Section 9 also we have divided into 2 parts, and the second part is being handled by Chaitanya. Last week I was referring about Vamana avatar in Dakshina, means in this thing, Dashavatara, where a small boy will come and measure the entire, in one leg he will measure the entire space, in another leg he will measure the entire world as such, universe. So Section 9 is like a Vamana, where it's a very, very small section, but it measures the entire universe as such. In Section 9, we have 8 subclauses, 9.1 to 9.8. Last week, Prasanna had covered 9.1 to 9.3, where in 9.1, we cover all the hits of income of a non-resident, like income from house property, business, capital gains, other sources. Then also we have something called covered about business connections and also the significant economic presence that is there with respect to the non-residents. Today, I think Chaitanya would have planned for sections 9.14 to 9.18. To remember 9.14 to 9.18, I've just made one single word. That is, you can remember these sections like DIRTY. D stands for dividend, I for interest, R for royalty, T for technical services, and Y for any sum of money received by a non-resident. So section 9.14, 5, 6, 7, 8, you can easily remember. And what is the importance of understanding Section 9? In Section 9, as you know, it is income deemed to accrue or rise in India. So any international transaction, if you want to do, or even in your day-to-day practice, if you have to issue a Form 15 GACB certificate, so first thing is you have to understand Section 9, then only you can move forward, because you have to see the taxability of that particular transactions under the Income Tax Act and also under the DTAA. So this is very, very important, and I should say this is the basic section. Apart from 4, 5, 6, and 9 are the basic sections for, or I should say it's the gateway sections for understanding international taxation. And I'm thankful to both the speakers who are giving us the basic subject on international taxation. By listening to these lectures, I think you can develop upon the international tax practice. And those of you who are not even into international tax practice, I think it's a very great base or foundation, I should say. Based on this, you can develop your international tax practice. I wish all of you a happy learning for the next 2 hours. Thank you. Back to Sneha.
Sneha, you are on mute.
Yes. Thank you for today's insights on the session, sir. So we have today with us to guide through the session, highly respected Mr. SP Singh, sir. He's an ex-IRS. He held various positions, including Director of Income Tax International Taxation and Commissioner of Income Tax Appeals. He was with Deloitte, India for more than a decade, where he led various initiatives. He is presently the Senior Advisor to the ICA. Thank you, sir, for joining us today. And today, our esteemed speaker is Mr. C.A. Chaitanya Isa, who will be presenting on topic of impact of Section 9 of Income Tax Act 1961 for non-residents. So it is part 2. C.A. Chaitanya Isa is in practice since 2005. He is qualified in the year 2005 January, qualified for Information System Audit with 3rd rank. He has completed the certification course of ICAI on international taxation. He is presently pursuing master's degree in international taxation from Nalasa University, Hyderabad. He has varied experience in statutory audits, internal audits, and tax audits. Clientele including various listed, unlisted companies, banks, insurance companies, trusts, firms, and other entities. He has been representing before various income tax authorities, has also been actively involved in preparation, presentation of appeals before CIT Appeals and ITAT Hyderabad. He has written articles on direct taxation for Chartered Accountants Study Circle, Chennai, and International Fiscal Association, Chennai chapter. He has been specializing in direct taxes with keen interest in international taxation. Thank you, sir, for joining us today. Over to you, sir.
Thank you.
Thank you, Sneha ma'am. Thank you, Sneha ma'am, for your well insights. And we request first SP sir for his opening remarks.
Thank you. Thank you, Prachi. Thank you, Sneha, for nice introduction. I would like to welcome all the participants and good afternoon. And thank Piyush ji and Kota ji, the torch bearers of the Committee on Direct Taxes. And thanks, Piyush ji, for giving a very bird's eye view of the initiatives which are being taken by ICAI in respect of international taxation. And thanks to Kota ji for setting the tone for today's discussion. We had one round of discussion on this subject last week, and there are several learnings from that. Friends, you must be wondering, what are the key learning? If I have to put it in 2 sentences, how would I put it? Because so many aspects were discussed and very, very fundamental concepts of taxation had been discussed. Those have been referred by Kota ji also, saying that Section 4, 5, 6, and 9 are the primary sections of the Income Tax Act, which lay down the whole gamut, the whole scenario of taxation in India. The one thing which stands out, and you must always remember, that all the provisions of Income Tax Act have 2 very fundamental concepts. One, there has to be economic relationship between source and the income which is sought to be taxed, whether it is interest income, whether it is royalty, fee for technical service, whatever business income, whatever it is, until unless the economic relationship is established between the source, that is India, and the income which is in the hands, we are being sought to be taxed in the hands of non-resident, you won't be able to tax it. That relationship has to be established. The second fundamental concept which runs through the Income Tax Act is the arm's length principle. This arm's length principle was adopted much earlier in the Income Tax Department in India, even before OECD had actually adopted it and given the publicity. As mentioned by Kota ji, Section 5 lays down the rules for taxation, the scope of taxation. In respect of a resident, the global income is sought to be taxed. On the other hand, in respect of non-resident, it is the source-based. Last, our meeting, that income tax law develops in a very, very interesting manner. So the policy maker first bring in certain provisions to tax certain type of income. Sometimes it is very narrow, sometimes it is very wide, affecting the whole business. So what happens? In the subsequent years, amendments are made to that provision. If you look at ATHHC, what it was, I mean, when it was introduced and what it is today. If you look at Section 9, what it was when it was introduced and what it is today, it runs in several pages. So they try to tax as much of income as possible. In case of the non-residents, this income has to be taxed only if it has association with India, the economic relationship is established with India. The deeming provision, in fact, is very interesting provision. It creates a legal fiction. There need not be a physical relationship between the income and the source. To fill in the gap, the deeming provision is introduced. And we have seen this provision extending the scope in respect of the business income by having the concept of business connection introduced, ACP, indirect transfer, and all those things. There are equally important, and I will share with you some basic concepts which have, in my entire journey in international taxation, fascinating me. Today we will be talking, in fact, Chaitanya ji will be talking about dividend, interest, royalty, and fee for technical services. It was always subject to taxation. It was always subject to taxation according to a normal rule of taxation. What happened, which makes all these provisions stand outside, is that in Finance Act 1976, introduced several important changes, the landmark changes, making, paradigm shift in the way taxation is held in respect of these 4 types of income. I will talk a little bit why this has been done and what is the basic reason for that. But let me first share with you what these sections are doing or what this amendment through the Finance Act 1976 introduced. It introduced several concepts. It defined a totally different set of determination of the rule of situs and scope of income. It is the only, these are the only provisions where the source is determined or the taxability or scope is determined on the basis of the payer. Nowhere, friends, this provision is like that. Here, and Chaitanya will be, Chaitanya ji will be discussing, what type of payer are and what type of income are subject to taxation in the hands of the non-resident. The other and equally important change which was introduced was gross basis taxation. Now, how it was done? 2 important sections were introduced or amendments were made. Section 44D and Section 115A. Section 44D introduced the concept of gross basis taxation. And what did it say? It didn't allow all the expenses. It said that it will be taxed on the gross income without allowing any deduction of expenses. 115A goes on to lay down the rate of taxation. And these rates are always lower than the maximum marginal rate of that particular year. Now, you may be wondering why these provisions have been introduced. These were not there right from the beginning. You will be very surprised to know that in case of royalty, it was net basis taxation which was prevalent before 1976. And it said that 25% of the expenses will be disallowed. So 75% of the expenses claimed by non-resident were allowed, and then the income was determined. This was found very unequitable, and there was a lot of protest. And that is when the non-residents were required to produce books of accounts in respect of royalty income, which was very difficult and impossible to implement. And that is why these provisions have been introduced in a particular way. Now, when we are looking at, and I'm sure Chaitanya ji will be sharing with you some of the controversies which are existing today and some of the controversies which are likely to come into existence the way the technology is taking place. He will discuss the clauses like make available and most favored nation. But my perception is that in future, because of the development of technology, the line dividing between royalty and FTS vis-a-vis business income, one, and the other one is royalty vis-a-vis fee for technical services is going to become very, very blurred. And one can hold it to be business income, the other person can hold it as royalty or FTS. So these are some of the important changes which have been introduced in the Act, understanding the basic concept and then understanding the development thereafter is very, very important. And I don't think that there can be any person more suitable than Chaitanya ji, who will do the real justice to this important part of the Income Tax Act. Over to you, Sneha.
Thank you. Thank you, SP Singh sir, for breaking down the Section 9 and how it has changed over time. It was insightful to understand the key changes that has been made to Section 9 over time, the rationale behind the provisions, and how they have been adapted. So now I would like to request Chaitanya E sir to take over and start with the session. We welcome you once again, sir. Over
Thank
to you.
I would take a second in sharing my screen and then I'll start my session. Good afternoon, everyone. Respected Chairman, Direct Tax Committee, Piyush Chajed sir. Respected Kota Shri Srinivas sir, Vice Chairman, Direct Tax Committee, Shri SP Singh sir, ex-IRS, Sneha, seniors and other friends. Good afternoon to all of you. I thank the Direct Tax Committee of ICAI for giving me this opportunity. I must pay my special respects to Kota sir for giving me this opportunity. Initially, when I was discussing, when Kota sir proposed to make me a speaker and asked me to speak on Section 9 Part 2, I was a little hesitant for the fact that my agenda was on various aspects of Section 9. And when I was asked to speak on dividends, interest, royalty, FTS, I was little doubtful whether I would be able to cover the entire gamut of all the provisions, considering the time that is being allotted to me now. If one were to undergo the certification course of the institute, each of this topic would qualify for a discussion for an entire day during the certification course. So that is in fact, I don't think even a day would be sufficient, but nevertheless, that is the length and the depth of each of these subsections. But I will try and put forth in concise words to the extent, to the best of my ability, whatever I would like to discuss on each of these particular topics. As you all know, Section 9(1), 4 to 8 is the agenda for the day. And I would start my slides probably, before making an introduction to Section 9, I would like to go back to the previous session where SP Singh sir had given his introductory remarks. In fact, they were very concise and very to the point on Section 9, where Singh sir talked about the word deem. He also discussed about the effect of a deeming provision within the provisions of the Income Tax Act. Sir was trying to define the word deem by saying that it is to judge something in a particular way. It is to put something in a particular way or to consider something in a particular fashion. So the deeming fictions try to either enhance the scope of income or reduce the scope of income, or they try to enlarge or constrain the meaning of a particular word. We all know what is the capability of a deeming fiction. Now, Section 9 is one such deeming fiction which has been introduced, which has been in the Income Tax Act for quite some time. What is the purpose of Section 9? That is something when I always thought about when I refer to the provisions of Section 9. Section 9, I personally opine that the purpose of Section 9 is to shift the place of accrual of income. It is to shift the locale of income from a place outside India to a place within India. If you look at the provisions of dividend, interest, royalty, FTS, all these things, without Section 9, ideally, most of the payments could have been, the accrual could have been outside India. So the whole purpose of introducing Section 9 is to ensure that the accrual is deemed to be happening within the boundaries of India country. So to give you a very small example, where do you think the place of accrual of interest income would arise? Where do you think the place of accrual of royalty? Where do you think the place of accrual of FTS could arise? Normally, the place of accrual would be at a place where the agreement for that particular service or for that particular activity is signed. For example, if I were to enter into an agreement with regard to delivery of technical services, then the place of entering into the agreement would be the place of locale of income. If the agreement is entered outside India, then generally the FTS would be deemed not to accrue or arise in India. If that is the scenario, most of the incomes which have a source in India, but the payment is being made outside India, in such cases, there is a possibility that those incomes would not be taxed into India. In order to overcome all that, Section 9 has been introduced, which is again, as Singh sir had already made it clear in his remarks, is a deeming fiction which tries to shift the locale of income from a place outside India to India. So most of the sections, especially interest, royalty, FTS, these are all source-based taxation rules, predominantly a source-based taxation rule, which tries to, as I said earlier, shift the income and thereby make it taxed. In achieving this purpose, Section 9 usually defines the manner in which the accrual happens, and Section 9 is a charging section, so it is only the accrual which is happening in accordance with Section 9. Taxability, as Singh sir had remarked earlier, is dealt with by other sections like Section 115A or your business income sections. So with this general background, we will try and move on to each of the particular topics. Before I go on, the other common question that would arise is whether Section 9 is applicable to residents or is it applicable to non-residents. In fact, an answer to this question is quite evident in Section 5. Section 5, as remarked by Kotha sir in his introductory remarks, deals with the scope of total income. And the scope of total income is given independently for residents, and it is also given independently for non-residents. For residents, the scope of total income, if I were to summarize it in a very colloquial language, I would say the global income of the residents is taxed, irrespective of where it has accrued or where it has been received. But in the case of non-residents, what is taxed is only income which is either received or deemed to be received in India, which is accrued or arising or deemed to accrue or arise in India. And in the case of residents, but not ordinarily residents, in the case of businesses controlled in India, incomes arising thereon would be taxed in India. So in the case of non-residents, effectively, there are only four scopes of total income, which is received in India, deemed to be received in India, accrued in India, and deemed to accrue or arise in India. So with respect to non-residents, Section 9 would take a prima facie, it would be of paramount importance. But with regard to residents, the scope of applicability of Section 9 would be lower because residents would anyway be taxed irrespective of the source of their income. Even if it is accruing outside India, there is a possibility that the income of the residents is taxed. So there is the relevance of Section 9 with regard to residents is lower, but with regard to non-residents, the applicability of Section 9 is of paramount importance. With this, we will quickly move on to the common formats which are there in the sections that I'm going to deal with. For example, if we look at section 915, sorry, section 915, 916 and 917, we would find that all of them have been drafted in one particular manner. If you look at the format, we can see that whether it is interest or royalty or FTS, if it is paid by government, if the payer is a government entity, if the payer is Government of India, or if the payer is a government, then it is always deemed to accrue or arise in India. There are no conditions attached. Any payment by a government to a non-resident would always be treated as deemed to accrue or arise in India. In this particular slide, all I am trying to say is that payment could be by different categories of person. Payment could be by government, payment could be by resident, payment could be by non-resident. But in all these three cases, the recipient is always a non-resident. So if there is a payment from the government to a non-resident, it is always deemed to accrue or arise in India. If there is a payment by a resident, if there is a payment by a resident to a non-resident, if the payment is from a resident to a non-resident, it is generally deemed to accrue or arise in India. There are only two exceptions. So in the case of a payment from a resident to a non-resident, it is deemed to accrue or arise in India. In all ordinary cases, there are only two exceptions. Those two exceptions are that one, it must be for a payment. If it must be for a business, it must be a payment in relation to a business or a profession which is carried on outside India, or it must be for the purpose of making or earning an income outside India. Only in these two circumstances, payment by a resident to a non-resident would not be deemed to accrue or arise in India. In all other circumstances, any payment by a resident to a non-resident would generally be deemed to accrue or arise in India. However, the scenario is different when it comes to a payment by a non-resident to another non-resident. Effectively, the payer is a non-resident and the payee is also a non-resident. In that scenario, the payment would be regarded as accrued or deemed to accrue or arise in India only in two circumstances. One, it must be in relation to a business or a profession carried on in India. Two, in the case of making or earning an income within India. So effectively, when the payments are between two non-residents, it is generally deemed not to accrue or arise in India only in two circumstances. That is, if it is in relation to a business that is carried on in India, or in relation to making or earning an income within India. Only in those two circumstances, the payments are deemed to accrue or arise in India. This is the broad framework within which the common sections like interest, royalty, and FTS would try to operate. In the case of interest, there is one more peculiarity attached, which is if there is a payment of interest by one non-resident to another non-resident, then the payment is deemed to accrue or arise in India only if it is in relation to a business or a profession carried on within India. It does not matter. I mean, in the case of royalty or FTS, even if it is for the purpose of making or earning an income within India, it will be treated as deemed to accrue or arise in India. But that is not the case in the case of interest. Interest covers only one leg of the deemed accrual or arisal, which says that it is only in respect of a business carried on within India, business or profession carried on within India. So this is how the sections are structured. This is how the accrual is deemed to happen, deemed to accrue or deemed to arise is going to happen within the three sections relating to interest, royalty, and FTS. These are the common points with regard to interest, royalty, and FTS. Now we'll go to one explanation which is below section 9. Section 9 has got two subsections, section 9.1 and section 9.2. Below both these subsections, there is an explanation which is inserted, and this explanation is applicable to only three items of section 9, which is again interest, royalty, and FTS. Clause 5 deals with interest, clause 6 deals with royalty, and clause 7 deals with FTS, fees for technical services. As far as these three payments are concerned, It does not matter whether non-resident has a place of residence or a place of business or business connection in India. It does not matter whether the non-resident has rendered service in India. All that it matters is whether the payment is deemed to accrue or arise in India in accordance with those clauses of section 9(1). If that is satisfied, then the accrual is deemed to have happened. There is no need to test whether the services have been rendered in India or not. The whole reason why this explanation has been inserted is that earlier the Honorable Supreme Court in Ishika Wajima stated that for an FTS to accrue or for an FTS to be deemed to accrue or arise in India, the rendering of the service must have happened in India. That was one of the conditions which was, although not there in the section, the courts have read that particular condition into the section in order to overcome that ruling, and also in order to overcome several rulings with respect to royalty, where they have always stated that the services must be rendered in India for that particular transaction to be called as deemed to accrue or arise in India. In order to overcome those rulings, the government has inserted this explanation to section 9, which clearly says that it does not matter whether the non-resident has a residence or a place of business or has rendered services in India. As long as the payment is satisfying the conditions mentioned in the respective clauses, it is always deemed to arise in India. This is the effect of the explanation, the sole explanation to section 9, which talks about the aspects relating to interest, royalty, and FTS. Having covered the common clauses, we will now quickly move on to the aspect relating to dividends. Dividends, the word dividend has been defined in the Income Tax Act in section 2, clause 22. Section 2, clause 22 has again 5 subclauses, clause 8, subclause A to subclause E. All these subclauses define the word dividend. Dividend is an inclusive definition. We all have already adequate knowledge about the dividend subclauses, particularly section 222E, which is also called as deemed dividend, wherein a loan advanced in a private limited company to a substantially interested shareholder is treated as a dividend, irrespective of whether that loan is repaid or not. So the word dividend, as explained earlier, has already been defined in the Income Tax Act, and it appears in section 2, clause 22 of the Income Tax Act. Now, the word Indian company has also been defined in section 2, clause 26 of the Income Tax Act. Now, when we come to section 914, which talks about taxing the dividends, which says that dividends are deemed to accrue or arise in India, it's all that the section 914 states is that it says dividend income paid by an Indian company outside India shall be deemed to accrue or arise in India. So when a dividend is paid by an Indian company to a resident shareholder, when the dividend is paid by an Indian company to a resident shareholder, the possibility of attracting section 9 is remote, for the simple reason that a resident shareholder receiving dividend within India is anyway taxed because the income is received in India. But what happens when an Indian company makes a payment to a non-resident shareholder? The non-resident shareholder's bank account is located outside India. Dividend is paid by an Indian company from India to a bank account outside India. In that scenario, there is a possibility that the shareholder, non-resident shareholder, would say that I have received dividend outside India, I am not liable to pay tax in India. Therefore, in order to overcome that problem, the Income Tax Act has introduced section 914, which states that dividend paid by an Indian company outside India is also deemed to accrue or arise in India. Therefore, a non-resident shareholder receiving dividend income from an Indian company will have to admit that income in his return of income in India and then pay tax on such income. Of course, there are withholding tax provisions, and subject to withholding tax provisions, if at all there is further tax payable, he will have to file a return and pay the tax. Otherwise, if the TDS is deducted in accordance with the double taxation avoidance agreement and the rate is not a rate which is below the rate prescribed under in section 115A, then he need not file his return of income. All that is for a separate discussion, but as of now, section 9 states that any dividend income paid by an Indian company outside India shall be deemed to accrue or arise in India. Now, this particular accrual or arisal is only in respect of a dividend paid by an Indian company. Indian company, if I have to define it in a very short way, it would only mean a company which has been incorporated either under the Companies Act 1956 or under the Companies Act 2013. Or a company which is a corporation which is deemed to be a company, or a corporation which has been established by a central, state or provincial act. So essentially, they are all referring to Indian companies, would mean companies which are incorporated in India. What happens to a company which is incorporated outside India? Take the case of a foreign company. A foreign company making a payment to a non-resident shareholder has got no economic nexus, no connection with India. So that can't be deemed as income deemed to accrue or arise in India. And now, by extending this a little further, even if the foreign company earns its entire income from India, if the foreign company earns entire income from India, it does not matter the place where the foreign company has earned its income, the dividend would again not be deemed to accrue or arise in India. Take the case where a foreign company conducts its operations completely within India. In that case, the foreign company may be expected to pay tax in India in accordance with section 9(1), but the dividends which are paid by a foreign company outside India would definitely not be taxed within India, because there is no provision to treat the payment of such dividends as accrued or arising in India. That is the reason why foreign companies are taxed at a higher rate than Indian companies, because the profits which are earned in India by a foreign company and then distributed to the shareholders are not taxed in India. Therefore, for those companies, the dividends paid by the foreign company outside India to the shareholders are always not treated as deemed to accrue or arise in India, because they don't fall within the definition of section 9(1)(4). This is all about dividends. We will now quickly move on to the interest part. Interest part is dealt with by section 9(1)(5). The word interest is again defined in the Income Tax Act in section 228A. Interest, as per the Income Tax Act, would mean two kinds of payments. One, money or interest paid in respect of monies borrowed or debt incurred. And two, it includes any service fee or other charges in respect of the monies borrowed or debt incurred. Now, this is the same definition which would continue to apply even in respect of all interest payments for which TDS is applicable under section 194A. So, if you carefully look at this definition, you will understand that the interest part would not only mean interest in respect of the monies borrowed or debt incurred, it also covers the service fee or other charges in respect of that monies borrowed. For example, in respect of a loan, if the borrower imposes a processing fee, then such processing fee would also be a part of the interest, which should be subjected to TDS. Similarly, if in respect of the monies borrowed, if the borrower levies other charges such as documentation charges or loan appraisal charges or such other charges as may be prescribed, then all those other charges would also be treated as interest for the purpose of the definition under the Income Tax Act. So interest would not only mean payment made beyond the principal amount, but it also includes other service charges and other charges in respect of the monies borrowed or debt incurred. So when you are subjecting the transaction to TDS, you should not just check whether it is interest payment alone. You should also check whether it is a service fee or other charge in respect of the same loan transaction. If your transaction satisfies these conditions, then definitely you should subject even the service fee and the other charges to the withholding tax provisions. Now, interest, the word interest is defined under the Income Tax Act. The same word interest is also defined under the DTAA. What is the meaning of the word interest under a DTAA? We will cover within the next 2 slides. But there are a gamut of case laws which have dealt with the definition of interest under the Income Tax Act. Now, let us look at the case of reimbursement of bank guarantee charges or corporate guarantee charges. Take the case of an example where a holding company, a subsidiary company intends to borrow money from a bank, but the bank refuses to lend the money to a subsidiary company. So in order to overcome this, the head office would provide a corporate guarantee to the bank, stating that in the case that the subsidiary does not pay, I will pay. As the holding company, I would pay the loan to you. So if the holding company gives a corporate guarantee to the bank, then on the basis of such corporate guarantee, the bank would make a loan, grant a loan to a subsidiary company. And this subsidiary company, having received the loan, if it tries to reimburse the holding company the guarantee charges, then would such reimbursement of guarantee charges be called as interest? Has been subjected to litigation in various cases, which would appear on your screen now. The presentation would also be circulated. So you can refer to these case laws in detail when you receive them. In these case laws, this particular aspect was subjected to litigation. In all the case laws, it was unanimously held that the payment is not in respect of a monies borrowed or debt incurred. There must be a direct correlation between the money is borrowed and the payment of the interest. In this case, there is a remote connection because what is being reimbursed is not interest. What is being paid is not interest, but it is reimbursement of guarantee charges. It would qualify as business income. It would not come within the definition of interest. Payment in respect of monies borrowed. Therefore, courts have unanimously held that this is business income and not interest. If you look at usance interest, what's meant by usance interest? For example, we try to purchase, one resident tries to make a purchase from a non-resident. Having received the purchase, there is a delay in payment, and for that delay, the non-resident states that you will have to execute an LC from a reputed bank, and the resident makes payment of LC. He makes payment of LC to an Indian bank or to a foreign bank. That LC would in turn pay the non-resident, and to the extent there is a delay in the payment, the nature of interest paid is called as a usance charge. Usance charge would usually arise in the case of payments in relation to LCs or where there is a delay in payment. Usance charge is something similar to your late payment charges. Usually when there is a delay in the payment of amount, then you'll have to pay late payment charges to your vendor. Your late payment charges is something very similar to your usance interest. In all the cases that are appearing before you, the courts have unanimously held that there is a delay in the payment of the purchase price, and therefore that purchase price would constitute amounts borrowed, and therefore payment of interest for such delay in the purchase price would usually be treated as usance interest, and therefore it will be subjected to TDS. This is all these cases talk about, all these case laws talk about cases where payment of usance interest was clearly, explicitly available. Now, the problem is even further compounded where companies adopt Ind AS method of accounting, where even though if the payment is within the due date as per the agreement with the vendor, there is a discounting charge that is applied, and then entries are passed in the books of accounts, and for the extent of the difference, it is being treated as interest. In that case, how do you effectively adjudicate before how do you effectively justify your case before the department that it is just a book entry for which is flowing from the treatment prescribed under the Ind AS, and there is no interest component in the purchase price? As long as it is a payment of a simple purchase price, I am sure there is no concept of interest accrual and therefore not subjected to TDS. But if for the Ind AS purpose, if there is an artificial splitting up of interest, then in those cases, there needs to be a proper justification before the assessing officer to show that the payment is only payment of purchase price and not something relating to interest. I would come to the last case, which is bill discounting charges. Usually bill discounting charges would happen when I have an invoice for which the payment is due in the next 90 days. The payment would come after the end of the period of 90 days. So I would go to a bank and ask him to discount my invoice and make the payment upfront. In that scenario, generally against the invoice value, the bank would discount using the rate that they have and then hand over a payment which is less than the invoice value. For example, if I've made an invoice for ₹1,00,000, which is receivable after 90 days. If I were to discount this invoice with the bank, they would give me an amount of ₹90,000 against the 1,00,000 invoice. And they would say that this ₹10,000 is towards the bill discounting charges. Bill discounting charges, again, although the terminology is very similar to something called as interest, it is not interest within the meaning of section 228A for the simple reason that there is no payment in relation to a monies borrowed or debt incurred. Therefore, on that account, bill discounting charges would not be treated as interest, and therefore there is no liability to withhold tax under either the provisions of the DTA or under the provisions of the Income Tax Act. These are the various kinds of transactions which could fall within the meaning of income tax, within the meaning of interest, or could fall outside the meaning of interest and have been most litigated in the present scenario. Now, if you go to the definition of interest under the DTAS, the definition of interest under the DTAS is quite different from the definition under the Income Tax Act. Under the DTAS, this has been the definition which has been commonly prevalent. I am not picking up any one particular or peculiar cases. Generally, amongst all the DTAs, this is a commonly available definition. It says that income from debt claims of any kind, every kind, whether or not secured by mortgage. So irrespective of whether it is a secured loan or an unsecured loan, or whether the debtor has a right to participate in the profits or not, every income from a debt claim and income from government securities, bonds, debentures are all treated as part of income. They only talk about income from a debt claim of every kind. So therefore, this is more or less similar to the first limb of the definition of interest under section 228A. They do not talk about the definition under the DTAA, does not talk anything about the charges levied in relation to the monies borrowed or debt incurred. Now, one specific line that has been included in the DTAA is that penalty charges for late payment shall not be regarded as interest. Therefore, if there is a late payment, and for such late payment, if there is an interest charged, it would still qualify as interest under the DTAA. But if there is late penalty charges which are levied, then such penalty charges would not be regarded as interest. Interest would effectively mean that mean the income which is arising from a debt claim. Debt claim is something similar to your monies borrowed or debt incurred. Only against that debt claim, if there is an income that is arising, it would be called as a interest income under the DTAA. So therefore, in my view, the definition under the Income Tax Act is wide and the definition under the DTAA is a little narrower. Now, there is one explanation to section 915 which has been introduced. All that the section explanation states is that in the case of a non-resident being a person engaged in the business of banking, then for the purpose of 915, the PE of that non-resident banking entity in India shall be treated as a separate and independent person as that of the non-resident person. And the provisions of the Act relating to computation of income, determination of tax, collection, and all these things would continue to apply. I would give a brief background of what was happening before this explanation was introduced. You look at the decisions given below with respect to ABN AMRO Bank and Sumitomo Mitsui Banking Corporation. In these two cases, there was a payment by the PE which is located in India to a non-resident principal which is located outside India. And that payment was treated as interest by the PE. And PE stated that in computing the profits which are liable to be taxed within India, you also have to give a deduction for the interest expenditure incurred by me. So on adjudicating, while adjudicating on this issue, the courts have held that in the case of determination of profits of a permanent establishment, you will have to necessarily reduce the interest expenditure which it is liable to have incurred with respect to payments to non-resident. But when you want to subject this interest expenditure to TDS, the courts have held that PE and the non-resident, both of them are one single person. There is no need for the permanent establishment to withhold taxes on the interest payment made by the permanent establishment to the non-resident. So effectively, interest expenditure from PE to head office was treated as an expenditure while computing the profits, but no TDS provisions were made applicable to it. In order to overcome this problem, explanation to the 915 was introduced, whereby by way of a deeming fiction, the PE and the non-resident are treated as two separate entities, and the interest payment made by the PE to the non-resident would be treated as a payment between two independent parties and therefore would be subjected to TDS as per the prevalent rates or as per the DTAA. Now, if you look, this has been clearly explained in circular number 19 issued on 27th November 2015. Now, if you look at this explanation closely, we can understand that this is only applicable if the non-resident is engaged in the business of banking. If the non-resident is not engaged in the business of banking, any payment from a PE to a non-resident would still be covered by the case laws mentioned in 1 and 2 appearing on your slide. So this proviso is applicable only in the case of a non-resident who is engaged in the business of banking. If the non-resident is engaged in manufacture or rendering of any other services other than banking, then this proviso does not affect that non-resident or its PE located in India. The second issue is with regard to payment of interest. Even in the case of a non-resident engaged in the business of banking, only in the case of interest, the PE and the non-resident are treated as two different persons. In the case of any other payment other than interest, they are again regarded as one person. There is no separate status that is being allotted to them. So this explanation is very, very specific. It is applicable only to a non-resident engaged in the business of banking, and the nature of payment from the PE to the non-resident is in the nature of interest. If you imagine a reverse scenario where a payment is being made from the head office to the PE in India, this particular section would not, this particular explanation would not cover reverse payments. So effectively, explanation covers payments from India to the non-residents. It does not cover payments from the non-residents to India PE, which is effectively income of the PE. Now, one problem that I envisaged while examining this explanation is that this explanation states that for the purpose of this clause, the PE in India shall be deemed to be a person separate and independent of the non-resident person. For the purpose of accrual of interest income, the PE and the non-resident are treated as separate and independent persons. Would that mean that whatever is the payment of interest made from the PE to non-resident need not be tested for arm's length under section 92? Would it be for the simple reason that the whole exercise of arm's length under 92 would only arise in the case of associated persons? By a deeming fiction, the PE and the non-resident are treated as separate and independent persons. They are not treated as associated persons, which is their original relationship. By deeming fiction, they are treated as non-associated persons. In such scenario, would provisions of transfer pricing arise is something that has to be discussed separately, because section 92 is again a separate chapter which is present in the Income Tax Act. How far does this deeming fiction affect those provisions would have to be tested independently. Having discussed this, I think I've covered the provisions relating to interest. Now I will quickly move on to provisions dealing with royalty. Royalty is something which is huge, which is a very large section, for the simple reason that number of cases have been subjected to litigation under this explanation or under this part of section 9.1. Now, the 9.1.6 talks about taxability of royalty. We have already discussed a royalty payment from government to a non-resident is always deemed to accrue or arise in India. Royalty payment from a resident to a non-resident is deemed to accrue or arise in India, except in two different scenarios where it is not deemed to accrue or arise in India. Royalty payment from a non-resident to another non-resident is deemed to accrue or arise in India only in two circumstances, which is when business is carried on in India or profession is carried on in India, or when it is for the purpose of making or earning any income in India. Now, what do you mean by royalty? Every time we have used the word royalty in 9.1.6, we need a definition for determining what is royalty. Explanation 2 defines the word royalty. Explanation 2 states that royalty means consideration for 1, 2, 3, 4, 5. There are around 7 parts which are given here. 7 parts. Any part fulfilling that nature is treated as royalty. Now, the royalty definition excludes from its scope income which is chargeable under the head capital gains. For example, I have got a patent on my name, or I've got a copyright on my name, and I am forsaking that patent, or I am selling that patent to another person with all the rights attached. I am not retaining any rights with me. I am completely selling the patent to another person. In that scenario, whatever is the consideration that would be received by me would be treated as income chargeable under the head capital gains. It is not royalty. The royalty would only arise when there is a usage of that patent. For example, the first 3 limbs of royalty definition talk about 7 different categories of assets. 1, patent, invention, model, design, secret formula or process, trademark or similar property. These are the 7 categories which are prescribed. For these 7 categories, there are 3 kinds of usages which have been prescribed. Transfer of all or any rights, or imparting of information concerning the working or use of, or the use of any of these patent, invention, model, design, secret formula, tracer. All this would constitute royalty. Similarly, imparting of information concerning technical, industrial, commercial or scientific knowledge, experience or skill. This would also be treated as royalty. The 5th one is use or right to use any industrial, commercial or scientific equipment. But the 4A, which is the 5th limb of royalty definition, does not include amounts referred to in section 44BB. Section 44BB talks about business income arising in exploration of mineral oils. In that section, they also talk about supplying plant and machinery on hire in the case of prospecting of or exploration of mineral oils. Where there is a supply of plant and machinery, in the case of exploration or in the prospect of exploring the mineral oils, that would be treated as business income. It would not fall within the limb of royalty. The 6th limb of royalty, which is given in subclass 5, talks about transfer of all or any rights within brackets, including grant of license in respect of copyright, literary, artistic, scientific work, including films, videotapes used in connection with radio, television, broadcasting. In fact, if you can recollect, I am sure you would all know by now that the 6th limb, which is discussed in class 5, has been the epicenter of litigation as far as taxation of computer software is concerned. So the 6th limb talks about transfer of all or any rights, including granting of license in respect of copyright, literary, artistic or scientific work. The last limb talks about rendering of services in connection with any of the first 6 limbs. That rendering of service, if it is related to these royalty, if this is related to any of the payments of royalty, then it would still be treated as royalty. It would not be treated as FTS. We will spend some time on the taxability of computer software because it is a very common phenomena, which is a common transaction which is applicable to all chartered accountants across. So what does computer software mean? Explanation 3 was inserted by the Finance Act 2001 with effect from 1/4/2002. It defined computer software. The word computer software has not only been defined under the Income Tax Act, it has also been defined under the copyright law also. Nevertheless, Income Tax Act has defined computer software. There is nothing much to discuss on this definition. But if you go to explanation 4, explanation 4 is strange for the reason that explanation 4 was inserted by the Finance Act 2012 with retrospective effect from 1/6/1972. The explanation 4, 5, and 6 of the 4, 5, and 6 to section 916 of the Income Tax Act. These three explanations were inserted by the Finance Act 2012 with retrospective effect from 1/6/1972. Because that is the point in time when effectively in section 9 had come into place. This was again dealt with by Singh Saab in his introduction address. So explanation 4 states that for the removal of doubts, it is clarified that transfer of all or any rights in respect of right, property, or information includes and has always included the right to use or right to right for use of a computer software, including granting of license. This was the key point. Explanation 4 read with the as I explained earlier, explanation 4 read with explanation 2 clause 5 have been the epicenter of discussion with regard to taxation of computer software. I will discuss about them in just 2 slides. As far as explanation 5 is concerned, the Act states that royalty is always deemed to accrued or arise whether or not possession or control is with the taxpayer, whether or not the person is directly used by the taxpayer, and whether or not that right is property or information is located in India or not. This is just to get over a couple of other judgments. I will deal with them in 2 minutes, in 2 minutes, in a couple of slides. But before I go, we'll spend some time on the provisions relating to the Copyright Act 1957. I will deal only with 5 sections of the Copyright Act, not more, because there are lots of sections of the Copyright Act which have a bearing on the taxability of computer software. I will not deal with all of them. I will deal only with 5 sections which are of paramount importance with regard to taxation of computer software. What does the Copyright Act state with regard to a computer software? Before we go, let us look at section 14 of the Copyright Act, which says that copyright means an exclusive right, which means an exclusive right to do the activities mentioned below. If you look, before I go, let me state that the word literary work includes computer programs, computer software. Therefore, I take it that the word computer software is already covered under the Copyright Act. Now, within the Copyright Act, it is covered by the word literary work. Literary work includes a computer program. So, for a copyright in a computer program to be valid, the person who is giving the copyright must be capable, or the person who is taking a copyright must be capable of doing the activities which are appearing on your screen. Clause A contains 7 activities. Clause B contains 1 more activity. Effectively, a person who is taking a copyright from the original owner must be capable of doing 1 or more of the 8 acts which are appearing on your screen. Only when he is capable of doing 1 or more of the acts which are appearing on your screen, he is said to be in enjoyment of the copyright. If he is not capable of doing any of these acts, then it means that he has got no copyright in that literary work. Now, as you all know, there has been a lot of discussion, and the most commonly referred to example is the purchase of a computer software versus purchase of a book. A purchase of a book is not treated as a purchase of a copyright. It is only treated as a purchase of a copyrighted article. So when I purchase a book, I am allowed to read that book. I am allowed to enjoy the contents of the book. I am allowed to retain the contents of my book in my own brain. I am not allowed to make a copy of that book and sell it, because the right to reproduce that copy lies with the copyright holder or with the original owner. It does not lie with me, because all I am doing is only purchasing a copyrighted article, which is the book. I can read the book, I can retain its contents, I can take the ideas from the book and expand on those ideas, but I cannot reproduce the book, or I cannot make copies of the book. Effectively, if I have to put it down in a very lighter way, an original idea can always be expressed in any number of ways. There is no copyright which prohibits you from doing that. If you have got an original idea, if two or more people have got a same idea, each one of you can express in any number of ways that you like. But you are not prohibited to express in the same manner as that of other person. So original idea remains the same. You can express it in one manner, another person can express it in another manner, but you cannot copy the expression used by another person. You can only express it in your own words. That is sum and substance of a copyright. Copyright is a right against the world. The person who has got a copyright, he prohibits all other persons in the world to do any of the acts which are mentioned on your screen. There are 8 acts which are mentioned on your screen. They are contained in Section 14 of the Copyright Act 1956. Section 16 of the Copyright Act says that no copyright in any work would lie other than as defined in the Copyright Act. So effectively, if you are referring to a copyright, it can only be within the 4 contours of the Copyright Act 1957. It cannot be beyond the provisions of the Act. Section 30 talks about the word license. The Section 30 talks about the word license, and this license is different from the owner, because the owner in a copyright can assign the license to another person, and the person who takes that license, the licensee, can do any of the activities mentioned in Section 14. But the only thing is that the license should be properly given by the owner of the copyright. And when I go to Section 51, 51 states that a copyright is infringed when a person other than the owner of the copyright or the licensee, a person other than the copyright owner or the licensee does any of the rights or the acts which are prescribed in Section 14 of the Copyright Act. So as mentioned earlier, there are 8 items, 8 rights. If any of those rights are done by a person who neither has the original copyright nor has the licensing granted by the owner, in those scenarios, he is said to have infringed the copyright. He is said to have infringed the copyright. Now, at this juncture, I would only like to tell you that whenever you enter into whenever you purchase a software, the first screen that would come on your whatever is your medium would be a list of conditions. Generally, they are called as EULA, End User Licensing Agreement. Effectively, an agreement would appear before you. You would, in all probability, scroll down to the bottom of the agreement. There is a button or an icon called as I agree. You would simply say I agree and then proceed with the screen. So what is it that you are agreeing to is only an end user licensing agreement called as EULA, End User Licensing Agreement. That EULA is not the same as the license discussed in Section 30. This juncture, I will quickly move on to the next slide, which is certain acts are not treated to be infringement of the copyright. What are those acts? To make backup copies of the software purely as temporary protection from loss, damage, or destruction of the computer program are called as are not treated as infringement of copyright. With this, we will see what was the decision of the Honorable Supreme Court in engineering analysis case. This is the decision of the Supreme Court, which said that computer software, any payment towards purchase of a license of a computer software is not payment in liable under 916, which is royalty. The Honorable Supreme Court said that a computer software is a literary work, and as it is a literary work, it has to fall within the ambit of the Copyright Act 1957. There cannot be any copyright beyond the provisions of the Copyright Act, because Section 16 very clearly says that The Supreme Court also stated that the word license used in Section 30 of the Copyright Act is not the same as the EULA that has been granted. EULA is a negative list. It only says you cannot alter the original source code, you cannot alter the software, you cannot make any changes to this. So all that they are restricting the user of that computer software from performing certain acts. Just because the user is allowed to make a copy for the purpose of protection does not mean that he is making copies under Section 14. And therefore, Supreme Court very clearly, Honorable Supreme Court very clearly stated that the license under Section 30 is not equivalent to the EULA. And therefore, what is granted under EULA is not a license. And therefore, whenever you purchase a computer software license, you purchase a license to use Windows, you purchase a license to use MS Word or MS Office, you purchase a license to use your ERP or your SAP, that does not mean that you are making a payment which is in the nature of royalty. Therefore, the payment for purchase of a license does not attract the provisions of 916 dealing with royalty. This was the sum and substance of the decision of the Honorable Supreme Court in engineering analysis case. This is a key decision which talked about computer software. Now, having discussed computer software till now, we'll quickly move on to the other aspects of the royalty definition. Explanation 6 talked about, defined the word process. Explanation 6 defined the word process, which would include transmission, uplinking, downlinking, and amplification of the signal of a satellite. This has again been subjected to a lot of debate and dispute. The word process has been discussed in all the cases that have been put forth before you and appearing on your screen. Department has argued that uplinking and downlinking is a process because effectively what the person pays is transponder higher charges. The nomenclature is transponder higher charges. Effectively, what is paid by the TV channels to the satellite company is for the use of, for the purpose of sending signals from India to that satellite so that they can relay that particular program across India. That is called as footprint. I will not go into the depths of it due to want of time, but I would only say that all the companies were utilizing an equipment called as transponder within the satellite. And the department argued that, see, you are using a particular item, industrial item, and therefore royalty definition covers use of an industrial equipment. Therefore, payment for transponder higher charges is royalty. Courts have held that it is not usage, it is not a payment for usage of the transponder. It is a facility which is extended by the satellite company. There is no absolute usage. There is no one person who is using the transponder. It is only a facility provided and there is a subscription to such facility. Hence, and the process is no longer secret. Therefore, the courts have repeatedly held that payment for transponder higher charges is not subjected to TDS under erstwhile 916. In order to overcome these decisions, there is a explanation 6 which is inserted, which said that the process would now include uploading and downloading of signal, downlinking of signal, amplification and all that. After explanation 6, I doubt whether the above judgments would hold ground, because after explanation 6, the word process is now adequately defined. Any payment in relation to the transponder higher charges would now get covered under royalty. Now, what is the way out? Although this has been defined in the Income Tax Act, the word royalty is defined in explanation 2, and explanation 3 to explanation 6 expand the word royalty, which is defined in explanation 2. Nevertheless, none of these would travel to the DTAA. DTAA stands isolated. The definition under royalty under the DTAA is quite precise. It does not, the explanation 6 does not go back to the DTAA. Therefore, whenever there is a payment towards transponder higher charges, assessees can still rely on the DTAA, provided the DTAA is available to you. You can still avail the provisions of the royalty in the DTAA and still treat the payment as not subjected to TDS. Again, as I said, the act is enlarged, the definition of royalty is enlarged under the act, but under the treaty it is concise. Therefore, reliance on the DTAA can be placed to the extent permissible. There are number of aspects on royalty like the domain name, web hosting charges, online advertisements. All these have been subjected to disputes. Not just these two, there are number of other cases like live transmission of data, payment for photographs, live photographs. All these have been subjected to disputes. I have just given few which are hot and current topics. There are a number of other case laws. I'm not explaining on them. You can read them at your leisure and understand that the word royalty is not something which is restricted to explanation to. It has been subjected to lot of debate and dispute. Now, I'll quickly move on to FTS because FTS also requires considerable amount of explanation and I'm running short of time. I will try and wrap up within the next 5 to 7 minutes. I would require time to address your questions, so I'll try and wrap up within the next 5 to 7 minutes. FTS would mean, FTS has been defined in section 917 explanation 2. FTS would mean any consideration for rendering managerial, technical or consultancy services, within brackets, the most important, including provisional services of technical or other personnel. So if there is a rendition of managerial services, if there is a rendition of technical services, or if there is a rendition of consultancy services, then it would qualify as fees for technical services. In that scenario, we need to understand what is the meaning of each of the words managerial, technical, and consultancy. The word managerial would mean something related to management. So if there is a payment in relation to management of an activity, if there is a payment related to a management of a position or management of a particular role responsibility, in that scenario, the payment would be treated as managerial service and therefore would fall within the ambit of technical service. Then what is consultancy service? If you look at the word consultancy service, it is very common that the word consultancy service the word consultancy comes from the word consultant, and the word consultant comes from the word consult. So consult would mean seeking deliberations, asking for advice. Therefore, consultancy service would always mean advisory services. The word consultancy has not been defined under the Act, but effectively consultancy service would mean asking of advice or opinion from somebody. That kind of deliberation is called as consultancy service. Now, we have discussed what is managerial service. We have discussed what is consultancy service. Now, in between these two words, there is a word called as technical service. What is meant by technical service? By technical service, we would only mean that a service which is related to technology. We mean a service which is related to technology. So, does it mean all technological services would fall within technical service? The answer again is no. Courts, as they appear on your screen in the decisions given there, courts have stated that the word technical falls between managerial and consultancy. Therefore, using the rule of nocere soices, the meaning common to these two words have to be picked up. The meaning which is common to managerial and consultancy should also be ascribed to technical service. Therefore, unless there is a human element of activity rendered, unless there is a human intervention through which the technical service is rendered, that would not qualify as technical service. If the service is rendered purely on the basis of technology without human intervention, then it would not fall within the scope of technical service. Essentially, because the word managerial would mean rendering of service by a human, the word consultancy would mean rendering of service by a human. Therefore, the word technical should also mean rendering of service by a human. Therefore, unless the technological service is rendered by a person with human intervention, it would not fall within the ambit of technical service. Having discussed what is managerial, technical, and consultancy services, we will now quickly go on to the word make available clause. This has again been subjected to umpteen number of disputes. There are innumerable case laws available on this make available clause. Generally, the Act does not talk about the word make available, but when you go to a DTAA, they talk about make available clause. What does that make available talk about? They say fees for technical services would mean any services for rendered in connection with technical or consultancy services, and they make available technological knowledge, experience, skill, or process, or in respect of transferring of a technical plan or design. Therefore, what is meant by make available? What is meant by made available? If you look at this term, they have very clearly said, umpteen number of judgments, this has been quite clearly explained, that make available would only mean that a person who is in receipt of the service must be capable of performing that service on his own next time. Must be capable of performing that service on his own next time. He should not again seek the service of the person who is rendering the service. So a person who is delivering the service or who is delivering the technical service must also ensure that he makes the knowledge in relation to performing of that service available to the recipient of the service. When that knowledge is made available, the recipient of the service will not again call him for rendering the same service. He will perform it on his own. Only in those cases, the payment would be treated as made available. In all other cases, the payment would not be treated as made available. Therefore, for an item to be called as FTS or fees for included services under the DTAA, wherever the definition includes make available, you will also again test whether the person who is rendering the service has made available the technology to the recipient. Is the recipient capable of performing the sales service again on his own without calling the person who delivered the service? If that is satisfied, then the make available clause is said to be satisfied. It will be treated as FTS. If make available clause is not satisfied, then the item would not be treated as FTS for the purpose of the DTAA. Select DTAAs have this make available clause. It is not that all DTAAs have make available. So please be very, very careful while testing the payment under FTS. You will have to see whether the make available clause is available or not. If it is not available, then you will have to proceed on the basis of the definition given under the Act or under the DTAA. More or less, they would be similar, excepting that DTAAs usually do not have the word managerial in their definition. Now, the last limb is with regard to provision of services. If you go to the definition of technical services, you can see within brackets, including provision of services of technical or other personnel, including provision of services of technical or other personnel. So if personnel are delegated, if the staff are delegated from one jurisdiction to another jurisdiction, that is called as secondment of service. There would be a person outside India. You can call him as the holding company. Holding company can send its employees from the foreign jurisdiction to an Indian jurisdiction. In that scenario, the persons who are traveling from the foreign jurisdiction to the Indian jurisdiction could come down and work on behalf of the delegated company. They could work on behalf of the subsidiary company. In that scenario, they would hold lien on their employment with the holding company, which is outside India. They could hold lien on the employment outside India. I am sure this is one subject which would have been covered by my predecessor in part 1, but nevertheless, I am trying to explain the concept once again. In this scenario, the problem is that when the Indian company or when the subsidiary company makes a payment of or reimbursement of the salary expenditure to its holding company, the department have always held that such reimbursement would qualify as fees for technical services. This is also considering the fact that the employees are making payment of the income tax on the salary income received or within India or outside India, because they are rendering the services in India, and therefore their salary income is subject to tax within India. Therefore, to that extent, the salary income is getting taxed in India. To the extent the employees of the non-resident have come and worked in the subsidiary company or the PE in India, they would constitute service PE. So to that extent, attribution of profits is there. Therefore, effectively, there is a service PE, there is a payment of salary, tax on salary income. Apart from these two, department have also held that reimbursement of salary expenditure would constitute FTS. On this, the judgments are divided. There are a number of judgments on the secondment and the related FTS. Centrica has been against the SSE, wherein they have held that such payments would constitute FTS. Morgan Stanley have effectively decided what is secondment, the case of secondment, who is the legal employer of those employees and who is the economic employer of those seconded employees. All that has been discussed in Morgan Stanley. Most of the decisions have stated, if I have to concisely put it in a nutshell, they have stated that if there is a service PE which is constituted, reimbursement would constitute FTS. And if there is no service PE, then the reimbursement would not constitute FTS and they would simply mean pure reimbursement of expenses without markup. That has been the decision. There is no clarity or there is no decided case law on this aspect, but nevertheless, I would concur with the judgments which are prevailing as of now. My last limb of the discussion is on gift to non-residents, which is dealt with by section 918. 918 talks about any income arising outside India being a sum of money referred to in section 224(17)(a) by a person resident in India. Section 224(17)(a) not only talks about any sum of money, it also talks about value of property. So when there is a payment of a sum of money, or when there is a gifting of a property without consideration or for an inadequate consideration, then section 224(17)(a) read with 56(2)(10) tries to tax it as income under the head income from other sources. The same has been imported with respect to non-residents. If at all there is a gifting of money by a resident outside India to another non-resident, if there is a gifting of money by a resident and this gifting happens outside India to a non-resident, resident gifts a sum of money outside India to a non-resident, in that scenario, that gift is deemed to accrue or arise in India, and therefore it will be taxed under, it has to be subjected to tax, it has to be included in the total income under 918. But nevertheless, 56(2)(10) would always apply. It would still exempt transactions between close relatives as defined in section, explanation to section 56(2)(10). Therefore, even if there is a gift outside India happening between a resident and a non-resident, as long as they are close relatives, as long as they are relatives as defined in 56(2)(10), then this provision of 918 would not get attracted. They would still be exempted. But where the gifting happens between two unrelated persons, then to that extent, the provisions of 918 would get attracted and therefore be subjected to tax, included in the total income in accordance with section 9. So originally it was meant only for non-residents, then subsequently it got extended to persons who are not ordinarily resident also. So this is how section 914 to 918 have panned out. I've tried to capture as much as possible. If there are doubts, I would be happy to take them at this juncture. Thank you so much for a very patient hearing. Over to you, Sneha.
Thank you so much, sir. Now I would like to request SP Singh, sir, if he wants to elaborate on any of the topics, sir.
I think Chaitanya has done real, justice to the topic. There are many complexities involved. And some of the complexities are in respect of defining the nature of the transaction and to find out whether they are falling within the definition of the royalty or fee for technical services or not. I will give a couple of practical suggestions to the audience. the most important of them being that all these things have to be established with the help of proper documentation. So whenever services are received, whenever any intangibles are received, there has to be proper agreement to show what are the types of activities being performed by the non-resident, number one. Number two, what are the types of the rights which are being handed over by the non-resident to residents? Because the definition of royalty, whether under the Income Tax Act or even under the DTA, require that there has to be, the sharing of some of the rights from the non-resident to the resident or to the non-resident in India. Say, for example, permanent establishment. If entire stock, all the rights are transacted, then in that case, the question will be whether it will be taxable as the business income or will it be taxable as the capital gains. When you are deciding whether it is capital gains or business income, the same, the logic has to be applied, which are applied in case of tangible assets. So a transaction may be capital gains in one circumstances, or it may be, the business income in other set of circumstances. So you must read, even the decisions other than, in case of non-resident, to find out how to differentiate between, the business income and the capital gain, and the same has to be applied here. That is one set of practical suggestion. The other one is that when you are looking at, it is incomplete until unless you see the definition of under the DTAA. And as Chaitanya mentioned, that the definition of royalty under the Income Tax Act and the definition as contained in the major DTAAs, you can say, are not identical. The definition under the DTAA are wider in some and narrower in others. For example, the use of equipment is covered under the our Income Tax Act, but it is not covered under some of the DTAAs. Most important, India's tax treaty with Netherlands. So these are the finer ones which one has to keep in mind, and while deciding whether a particular transaction falls within the ambit of royalty or not. Fee for technical services is sometimes it's very tricky. The first, it has to be established beyond doubt that it is in the nature of managerial, technical, or consultancy. It's not simply run-of-the-mill type of the services which are provided. This is an important aspect which has to be kept in mind while you are suggesting giving any advice to your client, or you are trying to prepare any submission before the appellate authorities. Now, I will just take 1 or 2 minutes to explain you why this concept of make available has come in. Earlier agreements, if you read, this make available doesn't exist. It started, the first tax treaty was that of India and USA, where this make available concept has been brought in, and then it has been repeated in the tax treaty with UK, Germany, and now most of the OECD countries, we have these provisions. Make available, in fact, goes along with service fee. So these two concepts have come together. One is the service fee and the other make available. So at the one hand, the recipient country may exempt it if it is not make available, but they will try to see whether it is constituting a permanent establishment or not. And this service fee is slightly, wider in the sense that if the services are rendered to, the associated enterprises, then even one day of the service will constitute a permanent establishment. Whereas if it is rendered to non-AEs or non-related entities, then 90 days or 60 days I mean, depending upon the DTA will be considered. So these are some of the finer points which need to be kept in mind, and you apply, the rule which I mentioned in one of the seminars, is that first you apply the domestic law and try to see whether a particular income is liable to taxation under Income Tax Act or not. If it is not taxable, then there is no need to go to the DTAA. If it is taxable, then try to find out whether the DTAA allows India, I mean the source country, to tax it or not. Once it you find that it also allows the source country to tax, then the rates will have to be applied either in the DTA or the domestic law, whichever is beneficial in view of Section 92(2) of the Income Tax Act. So these are some of the points which I thought, I must share with you. But Chaitanya has covered almost all the points. Though given the time, he has to restrain himself, but he expressed all important and salient features of these 4-5 types of income. Yes, Neha.
Thank you so much, sir. Thank you for throwing light on the complex provisions which needs to be looked into deeply. Coming back, we have few questions. So let us take up the questions now. First question, is TDS applicable for services provided out of India by foreign national residing out of India?
I gather that it is a payment between two non-residents. I am not sure about the query, but I gather from your from hearing you that it is a payment between two non-residents. Effectively, we will have to test whether the payment is in respect of a service which is utilized within India or not. If it is in the case of a service which is utilized in India, then definitely it would be liable for TDS. Otherwise, it is not.
Next question, whether expenses incurred by non-resident for earning interest income, will that expense be reduced from interest taxable income?
Can you repeat the query again?
Whether expenses incurred by a non-resident for earning interest income. So will that expense be reduced from the taxable interest income?
Yeah, it will definitely be reduced for the simple reason that while computing the profits attributable to a PE, you will have to necessarily take all expenditure into account which are incurred for earning that income. So definitely it should get reduced.
So
Yes.
there are two situations here.
Yes,
one is that, as Chaitanya has rightly said, that if it is, if the amount, the amount has been extended, the loan has been extended on which interest has been earned is out of the permanent establishment, then it is business income, and the net basis taxation will apply. But if the non-resident is located outside India, doesn't have any permanent establishment in India, then in that case, the gross basis taxation will apply, and the reduced rate or whatever rate is prescribed under Section 115A, rate with the concerned DTAA has to be applied.
Thank you, sir. In case of most favored nation clause, can we apply the most favored nation clause even though when there is no notification based on the latest amendment?
I think I missed out to cover MFN during my slide, but I sincerely apologize for that. But the MFN, the decision of the Honorable Supreme Court is very clear. It says that you should have a notification, and it is only in respect of an OECD country at the time of the notification. These are the two conditions which have been prescribed. When the Honorable Supreme Court has laid down those two aspects, going beyond them would not be right, is my view. Therefore, to answer your query straight, MFN may not apply. I would leave it to Singh sir for his remarks.
No, you are right, Chaitanya, because whatever decision was there, of the Delhi High Court, it was much more, the wider and liberal, you can say. The Supreme Court has, we may differ from the views of the Supreme Court, but the Supreme Court decision is the law for the land. And as Chaitanya has rightly said, that there are certain conditions which have been mentioned by the honorable judges of the Supreme Court for finding out under what circumstances MFN is to be honored. The Supreme Court has not said MFN is not to be honored. They have let down, the conditions that it should be like this. So those things have to be seen. So I will suggest you that please read that judgment, and because this was moved by the department, so I don't think that department will amend the law as they did in case of other provisions. So this is beneficial to the revenue.
I believe there is a review petition pending, sir, but
This is a review petition pending, but you know what happens, in a review petition, but the Honorable Supreme Court's decision is something which have to be followed. Yes, Neha.
Next question. When an Indian company receives commission by a foreign company for a service provided by this for an ocean-going vessel outside India, by mobilizing the spares from a company which is again outside India, whether on receipt is such receipt is taxable as service is rendered to that vessel outside India under Income Tax Act.
I believe the question states that the receipt is by an Indian company. An
Correct.
Indian company being a resident should always, the income should be taxable. There is no possibility of excluding that income. Had it been with a non-resident, the issue would have been slightly different, but an Indian company receiving the income, it should be taxable.
Yes, sir.
Actually, this shipping is very, very tricky because the person who has put the question may be aware that there are two types of leasing. One is the wet leasing, the other one is dry leasing. So you have to see. And then the other one is what type of the services, because there are cases, where, the crew are recruited by certain companies based in India. There are certain companies which are located outside India who do this and for which the fees are made. So you have to decide that you have to apply, the criteria which Chaitanya mentioned while discussing FTS, whether it is falling under the three heads or not. If it is not, then it will go beyond, FTS, and it will land in the domain of business income. And a business income is liable to taxation only when there is a permanent establishment. So this question is very, very fact specific. So you need to, analyze, who is the person, what type of the income is under question, and only then you will be able to apply whether this will be taxable under the Income Tax Act and the DTA or not.
Next question is, if the non-resident does not have PAN and he is receiving royalty income from India, how will the withholding tax be held, and what would be the refund situation for such non-resident?
Non-resident who is in receipt of income from India is bound to take a PAN. I'm not sure. I'm sure he's not covered by the exempt list for the non-residents who are exempted to not have PAN. So he's covered. He's definitely bound to take a PAN. And those who are withholding the tax have to deduct the tax, and before withholding, they'll have to test whether DTAA is applicable or not. For that, there are various other conditions, like you'll have to take a TRC, you'll have to take 10F, and then access to treaty should be granted. There should be a PPT satisfaction. All the other tests have to be satisfied. But nevertheless, I would principally say that if at all a treaty access is available, then the taxes can be withheld in accordance with the treaty. Otherwise, PAN has to be taken. In case there is no PAN, at least there must be a furnishing of the tax identification number in the country of his jurisdiction. And then accordingly, tax has to be deducted. And if the tax is not less than the rate prescribed under the Act, then the non-resident need not file his return of income in accordance with the 115A. Otherwise, he is bound to file his return of income in India also.
Thank you, sir. Last question. In case of FTS, if the assessee does not have any DTA benefit or DTA clause for FTS is absent, how will that FTS income be treated in India?
I mean, there are number of judgments which have said right from Andaman Seafoods. Most of the judgments have said that if there is no FTS clause, it is treated as a business income, and therefore, without PE, it would not be taxed in India. Department had been contesting that this should be brought out in the other income article of the DTAA, but courts have repeatedly held that if there is no FTS, it should go back to business income head. So I would go with those judgments and say that in the absence of a PE in India and in the absence of an FTS article, ideally it would be business income and not be liable to tax in India. But there is no concluded view as of now, or no decision from the Supreme Court. I would request Singh sir for his views on this aspect.
The yardstick is that under the Income Tax Act, all types of income are divided in certain, put under a certain basket by Section 16, isn't it? Section 16 says, there are these heads of taxation.
Section 14.
Is it Section 14?
14 talks about the heads of income, sir. 14 says that income has to be divided into the four.
About the, the salary income, income from house property, business income. This is divided by, Income Tax Act. And one has to see where is it falling. There can be arguments. So this is one of the arguments which I am sharing with you. Now, FTS or royalty, for example, is whether it is covered. Suppose there is no DTA, then whether that income will be subject to taxation under the business income, and under the business income, how the income will be determined, how the tax will be determined. So one view is that the Section 9(1) only extends the definition by deeming provision, but the nature remains the same. If it is a business income, it is a business income. And then once it is a business income, you go back to the DTA and see how, the taxability of business income is provided. This is one set of argument which Chaitanya just mentioned. What the department's view has been that, if some is not defined, and they are differentiating between all types of income and these four types of income. So there is a carve out. Section 44D specifically provided. Section 115A carves out a special domain. So if it is not, then in that case, it will fall outside the DTA, and the income tax law will be applicable under the, our act will be applicable. So these are the two sets of views which are being argued and at the different, fora. And what Chaitanya said is that there is no clear, final word. We are yet to hear from the Honorable Supreme Court what approach is to be taken. So we may have to wait till that day, but till that time, you can build up the argument of, based upon the decisions which are there. Yeah.
Yes, sir.
Yes, Neha.
So, sir, recently there was a notification from Ministry of Finance with respect to India-Spain DTA, where it was modified with a lower tax rate, which was adopted from India and Germany. And it became effective from assessment year 24-25 onwards. So does that mean this is applicable to transactions which are in assessment year 24-25 onwards only, and not to any assessments which is happening in that year?
Read the words of the notification, because notification is a beneficial provision. They are providing, if any, this is in what context, Neha? I haven't read it.
It is in most favored nation clause has been utilized here, sir, where the lower tax rate from India, Germany has been adopted to India, Spain DTA.
So the question is whether it will have prospective effect or retrospective effect.
Yes.
Notifications normally, unless they say that it will have a retrospective effect, normally they are prospective in nature. Okay.
Thank you, sir. I think that's it for the questions. I want to understand if there are any other points to be deliberated from Chaitanya sir or SP Singh sir.
I have nothing to add.
Yeah, no, nothing to add. The only thing which I will say, advise the participants that the two webcasts, I mean, the one which was on 6th and today's webcast will be available for some time. And you must, I mean, listen to these two very, very carefully, because very basic concepts have been discussed. And all these provisions are very fact specific. So you must read the decision and you must read, I mean, the facts of the case before you, and only then you should apply in a comprehensive manner. That's all.
Thank you. Thank you so much, sir. So on behalf of everyone today, I want to express our sincere gratitude to CA Chaitanya sir for such an insightful presentation on Section 9 provisions. As you have navigated through the provisions, you have simplified them for us, sir. So we are confident that this newfound knowledge will definitely be invaluable for our practice to make informed decisions in the practice. We are grateful that you have taken out time and your expertise has been put into this presentation. We are also grateful to our chair guiding us through the session today, our chairperson, highly respected Mr. S.P. Singh sir, for expertly guiding through the session. So today's session, I understand, has provided valuable insights on NRI tax implications from Section 9 perspective. On this note, I would like to conclude the technical session for today. Thank you once again, everyone, for joining us. Thank you, Direct Tax Committee, for providing support throughout the session for this. I have been given a great opportunity. Thank you, CA Prachi, for supporting throughout the session, and entire team of Direct Tax Committee for making this session a happy one. We hope you have found the session very informative. Thank you, sir. Thank you, everyone.
Thank you.